Welcome everyone to Steve Savant's Money, the name of the game. I'm your host, Steve Savant, syndicated financial columnist and money color commentator. On today's show, executive recruitment and retention, part 5 in our series, Tax Advantaged Income Investing with Indices, with nationally recognized retirement expert and certified financial planner, Chris Jacob. Welcome to the 5th segment, Chris.
Great to be here, Steve.
Chris, I'm all over helping businesses recruit top talent. I mean, the headhunters are out there. They're always looking for top talent. And I also want to protect my backside and keep the guys that are already playing for me that are good rainmakers, good administrators. I'm always looking for ancillary benefits, beyond my 401k contribution or providing medical. I'm looking for things that will really attract people to my firm and also keep people in my firm. Talk about how we're going to use indices, Index Universal Life, as a recruitment and a retention idea for high top-of-the-line key execs.
Yeah, business owners are always interested in the 3 R's, right? Recruit, retain, and reward. How do you do that given the fact that ERISA has got the purview of all the qualified plans and you can't have any discrimination there? In one of our previous videos, we talked about the professional's retirement strategy, whereby just as you would, as you probably started your business with OPM, other people's money, where you borrowed money to finance the business or major capital purchases. What if there was a way that you could indeed finance your employee benefits, especially your supplemental executive retirement plan benefits? And that's what we're talking about here. How can we keep and reward that key talent and attract that key talent where you can give them something else that they're not going to get anyplace else, okay?
Yeah.
And that's what we're going to show you here. So, as you recall from our last video on professionals' retirement strategy, we're going to borrow money. So that $333,000 a year that's going into the policy, that is with borrowed money. It's borrowed from a bank, okay, which is in turn lent to the business, which in this case, if we're looking to reward and retain and recruit, the business is going to own the policies rather than the individual, okay?
Okay, so the bank's going to take collateralization of the policy,
right?
Because that's what they need as an offset. Okay, so
correct.
So that's fine. So the business owner is only going to pay the interest.
Business owner is only going to pay the interest. That's it for 10 years. Now, what we're going to do here in the previous version, we had the key employee paying off the loan. We're actually going to have the policy do the heavy lifting, and the policy itself is going to pay off the loan, which will then generate substantial tax-free retirement income to this key individual. So to the tune of $184,000 in this example, and that will go all the way to age 120. But let's look at how this works.
Just stop for a second. I'm always amazed. We're looking at numbers that are going to 120. I mean, that's almost Jean Clement, who was the Guinness Book of World Records at 122 years. These things go out a long time.
Yeah, this is one of those policies structured this way. We want to make sure that the policy doesn't expire before you do.
Right, exactly. So I'm paying interest. I love that. That's leverage. I love leverage. And I'm recruiting a person. I'm going to put this money in, and the employee, how much does he put in? Nothing.
He's not really putting in anything.
Nothing.
Okay, zero. So what we did here, Steve, is we looked at, we've got several banks that are already poised to do this. Obviously, if this was a bleeding edge and not cutting edge, they wouldn't have any part of it, right? Major insurance companies participate in this. But the one bank that we have on the West Coast, their initial rate is blended interbank offering rate plus a spread, but they guarantee the max that it could go up over the 10-year period is to 5.95%. So this is a worst-case scenario.
That's their ceiling.
That's their ceiling. Can't go any higher than 5.95.
Contractually.
Contractually.
Wow, I love that.
Okay. So I know this is my worst-case scenario. Interest rates go up 225 basis points in the first year. Not impossible, highly improbable. Here's my interest on that loan, okay? So there's the cumulative loan due to the bank. There's my annual out-of-pocket interest, assuming worst-case scenario on the interest rate increase. Now, with this particular policy, we're going to structure it more of an income play, so therefore we're not using one of those high early cash value policies. There would be a little bit of a shortfall of collateral in the early years that they can post really a brokerage account, a letter of credit, a whole host of things that would cover that shortfall in collateral, which eventually disappears. The policy has enough cash in it that we don't have to post any.
Generally 2-3 years?
Yeah, we don't have to post any outside collateral, okay? So what we did here, just for as you're going to see comparison purposes, this is the true interest cost. That far left, the $52,800, is just the levelized interest cost of this plan over a 10-year period. It certainly is going to be less than this, but that is the worst case scenario. And at the end of year 10, we're going to have the policy. We're going to borrow $1 million against the value of the policy, pay off the outside lender. Now, company owns the policy, free and clear. So for $528,000 of interest cost, again, we're assuming that's not deductible, that's going to generate $6.4 million of total cash flow out of the policy. So how does that compare with the alternatives? What else could they do with this levelized interest? Well, what if we put it into equities, and let's assume equities got the world-class rate of return of 8% year in, year out, never had a down year. Let's say tax-free muni bonds got a 5% return. That's what you're seeing here in the middle part of the screen. Over on the far right are the values of the insurance policy, which have been supercharged with borrowed money. And in order to equate to $184,000 of tax-free income, spendable money in pocket, what you see is from the equities and from the muni bonds, that ain't going to last that long, is it? Because of the leverage and arbitrage that we have in our plan. So those others are tanked. They're out of money. This continues on. There is the differential on what I would receive from the policy versus what I would get even if I could find equities generating 8%. It's astounding, really, when you look at it. People say it's too good to be true. No, it's just the math. So I would have to, in order to generate the same benefits of the insurance at 6% funded with the borrowed money, in order to generate that same benefit, I'd have to get almost 13% a year compounded year in, year out without a down year. Or I'd have to see tax-free munis again generating 11.8. Do you want to see tax-free munis generating 11.8?
No, because that says other things that could be very bad.
It's bad. It's really bad otherwise. And think about this again, for the individual who is participating in this, they're taking an exam. They're not out of pocket anything, but they have to be there. There's a contract that says, you know, you have to work here until separation of service, or if they die, there is a benefit that's paid out to the family.
Either there's an employment agreement, or I have some kind of vesting schedule, something. So one of those two docs, depending upon how they design this, is that what you're using as a golden handcuff then?
That's a golden handcuff, definitely. And we're not even showing the pre-tax amount of this because it's a salary continuation plan. The company's taking the $184 tax-free. They're grossing that up, and they're paying that individual $300,000 roughly, okay, in the 35% tax bracket. So it's a heck of an incentive to stay there, all right? And if you compare this to our qualified plan, in a 40% bracket, if I took that interest cost of $52,800, I'd be able to pre-tax fund $88,000 a year. Well, yeah, I would have $2 million in my qualified plan right before I start taking the money out, but remember we talked about Webster's definition of gross is ugly and you don't get to spend it, because who's in that deal with you? Your favorite uncle. If tax rates stay the same, you're going to have to pre-tax take a little over $300,000 in order to net out that $184 within rather short order. There's not going to be anything left. So the comparison is no money there versus an income stream and death benefit here. It's about, what, a $4.8 million differential in income in pocket. I defy you to find anything that can do that and have discrimination associated with it.
The employee is receiving this free?
Actually, if the business owns it, the business is receiving it tax-free and then grossing up that as a salary continuation
like maybe a 162 bonus of some sort.
Exactly.
So he gets the tax gets extra money to pay the tax.
Right. He's still going to net out basically the 184.
Okay. Well, he hasn't paid anything. So
he hasn't paid anything. It's a pretty good deal.
Pretty good deal. Yeah.
Yeah. So in a qualified plan, you'd have to almost be generating 12% in order to match the benefits of this plan. So it really is something that I've yet, in 33 years in a business, I've yet to find anything like this. I mean, I've got a premium finance policy on my own that I implemented back in 2012. Unfortunately, mine was not funded via the business. It went directly to me. There's a whole host of planning opportunities with this, from small firms to very large firms. For instance, we have this one firm that is a CPA firm that was reviewing this on behalf of one of the clients who we proposed this to. They did their due diligence on it, and they said, yes, this looks good. As a matter of fact, we've been looking to do something for our principals. And they implemented, Steve, a plan for the top 5 principals of the CPA consulting firm, one of the largest on the West Coast, as a matter of fact, and then subsequently implemented it to give their junior folks something. Because in those service contract companies like CPA, law firms, what happens? Those senior partners, they retire, and they typically get paid a set amount for a number of years, but what does that do for all the people who are left? It pulls down on their revenue. So how can we find the money to pay those retiring senior partners without it having, I mean, you talk about negative adverse selection. If I know coming into a business that I've got a group of senior partners retiring, and that's going to reduce my compensation because I'm going to have to produce in order to fund that benefit, is that a place I really either want to A, come to, or that I want to stay? I don't think so. This helps offset that to a great degree.
Well, I love the leverage of this play. Huge recruiting benefit. You're trying to get rainmakers to play, and a wonderful area to keep the good people that you like that are really talented, really helping your business retain those employees. Fantastic. Well, I want to thank you, Chris, for sharing this series on tax advantage income investing with indices. And keep in mind, before moving forward with any of the ideas on our show, always check with your tax consultant, legal counsel, or your financial advisor. You've been watching Steve Savant's Money, the name of the game.